For venture-backed startups, an exit isn't just about maximizing valuation or achieving liquidity, it's about delivering the returns that VCs, and ultimately their limited partners, expect. Startups and VCs don't always have identical goals, but it's the VC's role to clearly communicate their expectations, which are directly tied to their fiduciary duty to LPs. LPs, whether pension funds, endowments, or family offices, commit capital to VC funds with a clear mandate, generate high multiple returns within a defined timeframe. This shapes how VCs approach exits. It's not just about what works best for the startup alone. It's about structuring liquidity events that align with fund timelines, portfolio-wide return targets, and risk considerations. As a VC, ensuring alignment between your portfolio companies and LP expectations is critical. A well-planned exit benefits not just the founders, but also the fund's ability to deliver on commitments, maintain strong LP relationships, and raise future capital. Misalignment can lead to tensions, suboptimal exits, or pressure to sell prematurely. Ultimately, exits don't happen in isolation. They require years of strategic planning, positioning, and negotiation to align startup growth trajectories with investor return expectations, creating outcomes that work for all stakeholders involved. Venture capital funds don't last forever. They operate on a fixed life cycle, typically around 10 years, which means there's a built-in urgency for VCs to return capital to their LPs within that timeframe. This reality directly impacts when and how a startup exits. For early-stage funds, those investing in seed and Series A rounds, exits generally need to happen within 7 to 10 years to provide LPs with liquidity before the fund closes. Later-stage funds, such as Series C or growth equity investors, have an even shorter timeline. They typically expect exits within 3 to 5 years of their investment. And there's another layer of complexity: the age of the fund itself. LPs in older funds, approaching the end of their life cycle, are likely to push for faster exits, while LPs in newer funds may be willing to wait longer for a larger outcome. This directly impacts how aggressively VCs push for IPOs, mergers and acquisitions deals, or secondary sales. For founders, understanding these constraints is critical. Those who can navigate exit negotiations with a clear view of the pressures their investors are facing. Not all LPs think the same way, and their expectations influence which exit strategies are most attractive. Institutional LPs, such as pension funds, university endowments, and family offices, are often patient investors. They're willing to wait for long-term returns and typically favor IPOs or large-scale acquisitions that provide significant liquidity events. Because of their long-term outlook, they're less likely to push for quick exits, giving VCs more flexibility to hold onto high-growth investments. Corporate LPs, those investing through corporate venture arms, are a different story. They're often driven by strategic interests rather than purely financial returns. Many of them prefer mergers and acquisitions exits where their parent company can acquire the startup and integrate it into their business. As a result, they may have a direct influence on when and how a company gets sold. Then there are fund of funds investors and private equity LPs. These investors focus on efficiency, investing in multiple venture funds and expecting consistent, high multiple exits. Because they prioritize capital efficiency, they often push for liquidity sooner rather than later. For them, secondary sales and acquisitions are often preferable to waiting for IPOs, as they reduce risk and lock in returns more quickly. Sometimes, founders and investors don't see eye to eye when it comes to exit timing. And when that happens, friction can emerge, tension in the boardroom, conflicts over strategy, and in some cases, forced sales that don't serve the startup's best interests. Take a situation where a founder wants to keep their company private longer, believing that more growth is ahead, but early investors need liquidity before their fund closes. This is a common misalignment. One solution? Secondary sales, where new investors buy out early backers, allowing the company to stay private while still giving liquidity to those who need it. Or consider a scenario where a founder is aiming for a $1 billion IPO, but investors are pressuring for a $300 million acquisition. From the VC perspective, that acquisition might guarantee strong returns for their LPs, even if it means selling before reaching full potential. In cases like this, founders may negotiate earnouts or structured deals to align incentives for both parties. And then there's the challenge of VCs pushing for a quick merge or acquisition when the company simply isn't ready. This often happens when a venture fund is nearing the end of its life cycle and needs to exit its positions. One potential solution? Rolling over investors into a continuation fund to extend the company's runway and maximize value over time. When these kinds of misalignments happen, open communication between founders and VCs is critical. The best exit strategies aren't made under pressure, they're planned strategically with all stakeholders aligned. The most successful exits are designed to balance investor returns with the long-term potential of the company. Instead of an all-or-nothing approach, structured exits, such as earnouts, secondary sales, and staged acquisitions, can create win-win scenarios. For example, if early investors need liquidity, but the company isn't ready to exit fully, later-stage investors can step in to buy out their shares. This reduces pressure on the business while ensuring that LPs get their returns. Some startups pursue dual-track exit strategies, keeping IPO and mergers and acquisitions discussions open simultaneously to create multiple paths to liquidity. In any case, the key is to plan ahead. Rushed exits rarely maximize value, but those that are strategically structured with LP expectations in mind lead to better financial and strategic outcomes for all parties involved. A successful exit isn't just about selling a company. It's about ensuring the right timing, the right buyer, and the best possible outcome for all stakeholders, particularly investors. As a VC, you're not just backing founders, you're managing LP expectations and fund performance. This means actively guiding portfolio companies toward exit strategies that align with the fund's return targets and investment timelines. The best exits happen when VCs work closely with founders to explore multiple liquidity options, maintain strategic positioning, and ensure that potential acquirers or public markets see the full value of the company. A well-structured exit doesn't just maximize financial returns, it reinforces the VC's track record, strengthens relationships with LPs, and sets the stage for future fundraisers. Because in venture capital, an exit isn't just a financial event, it's the result of years of investment, strategic growth, and risk management. The VCs who get it right ensure that every exit not only delivers strong returns, but also opens the door to the next opportunity.